One, depending on where you're. We're glad you're with us. If you've been to one of these sessions before, it's because your organization has subscribed to the WellCents service. And so, what we try to do is, in addition to offering you opportunities to meet with advisors, obviously, when we're on site or doing virtual meetings with your organization, we want to obviously keep you in the loop with what's going on just throughout the year. And so, these are some nice touch points. I've been with you before, Stuart Skolton. Great to be with you all. I have with me today Brian Jarosinski. I'll let you introduce yourself, Brian, and also Christopher Powell, our guest speaker and CPA. I know his time is very valuable this time of the year. So thanks for being on, Chris. Brian, why don't you tell everybody a little bit about yourself, and then we'll get down to Chris and we'll kick the show off today.
Yeah, so first off, I appreciate everyone's time. It's a busy time of year, obviously, with tax season, and the markets, are all over the place, and interest rates are all over the place, and inflation's at 40-year highs. So, Stuart and I and NFP, we try to do these for our retirement client folks to get you some good information, make sure you're available, or make sure you understand that we're available as resources for you for all these kinds of things. So, again, just my quick background, I recognize some names from the last couple of these that we've done that I was on. I've been in the business 17 years. I'm a board certified financial planner. I have a master's degree in financial planning. Me and Stuart are in the wealth management financial planning arm of NFP, which is, for those of you who aren't familiar, NFP is the 5th largest consulting firm in the world, and certainly, one of the biggest domestically. So we're here to help any way that we can. We really look forward to doing this, podcast style type of a thing to talk about taxes. I'm sure it's probably on all of your minds. So we have a good amount of topics that we're going to go over and discuss. And I got one of my very good colleagues and partners with Chris on the CPA side to throw questions at him. And we'll talk through lots of topics that hopefully you guys can either take back to your CPA or get to Chris or email Stuart and I, and we can help make sure we're helping increase your wealth and limit the tax liability as much as possible. So with that, Chris, let me turn it over to you, give you a little introduction, and go from there.
Yep, thanks, Brian. So I've been practicing accounting for roughly 10 years. I graduated in 2011, got my CPA license in 2012. I formerly worked at a national firm, RSM, which was previously known by McGladrey. I worked there for about 3 years in audit and assurance services, and now primarily work in tax services for both businesses, individuals, and corporations, but also still provide assurance services such as audits and financial statement reviews as well.
Nice. So, Chris, I think, is it safe to say that this is the craziest time of the year for you? When does it really start to pick up? I don't know, just for you in general. Is it around February when people start getting around to sending you their W-2s, or kind of what's your year like if you were to kind of summarize it?
I personally wish that we got busy starting in February, but actually for us, it's about January 1st. And the reason the rush starts for us so early is because we still have a number of small business clients that we do payroll returns for. So we're not actually just necessarily waiting on W-2s. We're actually helping a lot of them prepare their W-2s and their last quarter payroll filings as well. So we're crazy about January 1st, and then it really doesn't stop until April, unless the IRS extends it again, and then we just never seem to stop now.
No, that makes sense. Well,
real quick, just so everyone's aware, just logistically, any questions, utilize the bottom Q&A, pop questions to it as much as you want. Raise your hand. We want this to be as interactive as possible. So, we're going to go through a bunch of topics, but as we go through them, please, by all means, pop a question in the Q&A, and we'll get to it one at a time so we can get you guys the valuable information you need specifically.
Yeah, thanks, Brian. I was about to mention that. I also want to just fire off our first poll question for today, which I think is just so relevant. You'll see it come through here on your screen, but really the question is, do you like doing your taxes? So maybe if you're
we have a lot of yeses. Look at this.
Let's see here. We're going to let the poll come in, and then we'll show you guys the results. So keep giving some feedback. If you're like me, I don't dread doing my taxes. Typically I have enough withheld out of my paycheck throughout the year that I'm usually getting some refunds back. I think in the back of my mind, there's always that specter of a potential IRS audit, which thankfully hasn't happened to me, but you hear the horror stories. So, I don't know, Chris, what are some things that people can do or be thinking about really to to avoid the audit if we were to just jump into it. And I'm going to end the poll here, and let's share the results with everybody while you're working through that.
Wow.
You know,
Who are these 23%? I want to talk to these people.
they must also be accountants.
Yeah.
So I think the question was, what do you do to avoid an audit? Really, we don't, oddly enough, we don't see many audits anymore because the IRS has just been so burdened with all the new laws, tax changes, and many of them have worked from home for the last year. So they have an incredible backlog. But some of the main things that I would say are, try not to take any unusual or extra risky tax positions. Try not to get too cute with things. Try to complete 1099s if you're a business owner. That's one that sometimes gets people. They forget that they have to do that. Another area that we're really, the IRS has really started to crack down is for those with corporations, S corporations. If some people are familiar with those, in which they've got owners that aren't taking a reasonable salary, which is something that the IRS requires you to do. But there's a number of things that you can do to avoid audits. But fortunately, I guess for the taxpayer, we really don't see that many of them anymore, which is good because it's about an hour wait to get through to the IRS on the phone if you even need to talk to them.
Okay. No, that makes sense. I mean, Brian, what are you talking to clients about? Like, I know, the people that I'm working with as an advisor have tax questions, and, our knowledge goes so far, and we can definitely help people in that area. But then there's a certain point where we like to bring in an expert like Chris. I mean, what are your clients kind of asking you that you tee up this tax conversation?
Yeah, I think at the end of the day, I was interested by that poll, but I don't know anyone who loves paying taxes, right? Like, no one enjoys paying taxes. So the name of the game, again, me and the financial planner desk, the certified financial planner seat, it is extremely important that I get to know the CPA of my clients extremely well. For anyone on the call who has a financial planner, has an accountant, if they're not talking to each other all the time, they're not doing a very good job of what they do. Because in my job, I have to know what your tax situation is, because ultimately there are some freebies, which we're going to talk about today, where you can really minimize the tax burden just by doing things right on your tax returns. One of the things that I see a bunch is trying to max out your retirement plans, right? So obviously most of the people in here are in 401k plans that NFP manages. A lot of times these days, especially in the older population, believe it or not, I see people in their 40s, 50s that are doing like half of their 401k in the pre-tax and half in the Roth. When in actuality, as I could kick it back to Chris, but the 401k deduction is an above the line deduction. So it really helps you from a lot of other perspectives beyond just saving tax dollars. So you'd be better off actually using your 401k for pre-tax and then doing things like either Roth IRAs or backdoor Roth IRAs. You just have to be careful about how you do them and make sure they're valid. We do this kind of stuff all the time, but just little things like that we see all the time can save people $3,000, $4,000, $8,000 a year in taxes that they didn't have proper planning on because their planner or their accountant or they're not talking together and they're missing those freebies.
Yep. So I would kind of piggyback off what Brian has said there, and especially for most of the people that are on this webcast that fall in the place of employees. If you're an employee for somebody, it sounds kind of boring, and believe me, it's a tough sell with a lot of clients, but the easiest way to cut back on those tax dollars really is your retirement plans. And I wrote down some figures here. They change a little bit every year because they're adjusted for inflation and whatnot. But if you're an employee, for example, a 401k, the limit for 2021 is $19,500. So basically, to put that in simple terms, if somebody makes $100,000 a year, if they were to put $19,500 into that 401k, you're actually only going to report $80,500 for income on your tax return. So if you just do some simple math on that, and let's just say you're at a 20% tax rate, which actually isn't a bracket, but it's just a nice round number. 20% of that figure is going to be $4,000. So there's $4,000 in savings there. And the numbers can get even better for some of those people that, for instance, we see a lot of our small business clients where they have a business and they're actually able to contribute for an S Corp. You can contribute as an employee with a wage, But then the company can turn around and actually match your contributions into those plans. And the IRS actually allows up to $58,000 for 2021 for both employee and employer matches in most cases. So you're talking about huge tax savings.
So, I mean, Chris, I think, it's safe to assume that probably everybody on the call is participating in their employer sponsored retirement plan. Like that's something we really push and we emphasize, obviously being a retirement plan advisor. But, I often get questions about, just tax efficient investing outside of the retirement plan. So maybe they're, maxing out their 401k or they're putting a contribution in, they're getting some of those tax breaks in the current year, but maybe talk or share with our listeners some of the other tax efficiencies we can look for, like capital gains, when to tax loss harvest for outside brokerage accounts, things like that. I mean, what do you typically recommend with your clients?
Yeah, that's a great question. In fact, one of those, there's one that I would highlight that I actually personally take advantage of. And for people that even if you are in an employer plan, as long as your income stays below, so for single, if you can get your income, your modified adjusted gross income below $140,000, then you can actually contribute to a Roth as well. So so put that, just want to lay that out. So if you contribute $19,500 to your 401k on a pre-tax basis, you are actually allowed to actually have a Roth on the side and put up to $6,000 in that separate from work. And the beauty of the Roth is you don't get the tax break right away, but I really recommend it for younger clients because you get the money tax-free when you withdraw it, and you're not subject to required minimum distributions. So it really creates a big potential to grow a large account balance over time. And then, so you want to, capital gains was another question. That's a great question that I would definitely highlight. And it's a great way to put away some money. So for people that don't know, there's essentially two main types of income. Ordinary income is what you get from job through your day-to-day activities at work. The other one is capital gains, which is essentially income that you're not producing as a wage, or income that comes from capital assets. The one that everybody thinks about typically is stock. And it's a great example because for those that don't know, capital gains rates are always more preferential than ordinary rates. There's three capital gains rates. There's 0%, 15%, and 20%. And that depends on what your overall income and where that lies. But for a great example here, here's a great tax savings plan. If you can keep your taxable income lower than $40,000, for example, as a single person, and you were to invest in a capital asset, say Apple stock, and it tripled in value, if you can keep total taxable income under $40,000 and you sell off that Apple stock, that entire gain is tax-free. So your tax rate on that stock is 0%. And then it's all intertwined, guys, because if you take that and go back to our previous example of the 401k, well, how can I get my taxable income down to $40,000? Well, if it's $60,000, just contribute almost $20,000 to your 401k. So then you get the pre-tax dollars in the retirement plan. Then you can take money on the side, invest in the stock, and now you get the capital gains at 0%. So it's really important to understand, the value of, not just working and saving for a living, but also investing, because you really do get preferential rates, and that gives people a great opportunity to appreciate some of their net worth and their value.
Yeah, I love that. I love that. I think more people should take advantage of it. We've had some really good questions coming in, so let's get to a few of these. One that I think was a really good question, and I actually just did this myself as I was rounding up tax information. Are there thresholds on write-offs for things like material donations, clothes, appliances? Maybe those old things we have lying around the house that we're taking to Goodwill or like a warehouse.
Yeah, so there are some rules. Well, there's many rules for charitable deductions, but so for some of the basic ones, it's important to highlight and look at whether or not you're actually able to get any bang for your buck there. So since 2017, a lot of people are familiar with the Tax Cuts and Jobs Act, which changed some of the rules. One of the rules that changed was the standard deductions increased for everybody. Because the standard deduction increased, it becomes harder for people to itemize deductions. Everybody, if people don't already know, you get to choose between a standard deduction and an itemized deduction every year. Generally, you take whichever is larger. Charitable contributions are lumped as an itemized deduction, but you don't get the itemized deduction unless they're greater than standard. So I'll wrap that up and bring a long story short. For a single person this year, a standard deduction is, I believe, $12,550. For a married person, it is double that amount. If you don't have charitable deductions in excess of those amounts, then it's really not going to give you much benefit. Aside from that, if you are able to, max up your charitable deductions and throw in some other itemized deductions like home mortgage interest, real estate taxes, if you can get that itemized number above the standard deduction number, then it benefits you.
Got it. Got it. Brian, I know we're getting a ton of questions here. Are there any that jump out at you that maybe we should just address real quick?
Yeah, well, I saw a couple on the Roth IRA. How much can I contribute? If it's a Roth IRA, just real quick, it's $6,000 per person, and if you're going to turn 50 this year or over 50, it's $7,000. Again, contributing to Roth IRAs though do have an income limitation, so you want to check that out. Otherwise, you could do backdoor Roths, assuming you don't have any traditional IRA monies, because there's a pro rata rule there. But that was a good question. Again, one of the things I wanted to hit before going back to the questions, to your point on capital gains, is you guys probably always see it like with all the social media, right? Like Warren Buffett always talks about it, that his assistant pays more in taxes than he does, because at the end of the day, the way the tax code is set up, and we're going to talk about a lot more of these today in the webinar, is the system is really set up to invest and not consume. So if you're investing in business or rental real estate or stocks, you really don't pay taxes. That's why Bank of America doesn't pay taxes, Apple doesn't pay taxes, Amazon doesn't pay taxes, because they reinvest their money into the business, into the system, and the way the tax code is set up, they don't have to pay those costs. That's the same thing when you buy stocks. I got a good client, we were just talking the other day, where in his brokerage accounts, he's just buying individual stocks, and he doesn't even plan to use them ever. But eventually, when he, when he isn't here anymore, there is a step. He gets what's called a step up in basis. So to what Chris's point was talking about before, if he bought Apple stock 100,000 worth and he dies in 30 years and it's worth 3 million, that 3 million goes to the next generation tax free with a updated in their step up basis. So it's things like that where these mega wealthy are paying 15-20% taxes, where many other people who aren't familiar with some of these strategies, they're paying that 25 to 35% bracket. So it's important to understand the things that they're investing in and how they're driving their income to help minimize your tax burden.
Yeah, I think that's definitely right. I think that, well, one thing I'll tell all my clients, and some of them kick and scream, if you're going to make money, you're probably going to pay somewhere. So I will say that there's typically not a completely free ride. And you also notice as you begin to earn more that those overall rates tend to sneak up a little bit on you. But as like Brian said, one of the big things is, you're comparing people to somebody like a Warren Buffett. The big difference there is the capital income. So much of his income is from capital resources, such as stocks or investments, that just aren't taxed the same as a wage is taxed. So it's important that people understand that distinction and realize that, there's no limitation on that. Anybody that wants to invest can invest. So it is a great way to use that code to maybe get your rates to drop down a little bit.
Yeah, no, that makes sense.
To that point, when I build retirement income plans for folks, a lot of people have the 401k, right? But when the 401k comes out and you're taking income, that's ordinary income taxable monies. So having Roth monies, not only is that tax free, but also building up brokerage accounts where you're selling stuff and only paying 15% on that money allows you to generate more wealth over time and pass it on to other generations. So let me hit some of these questions I saw. So I'm unable to add to my 401k, but I would be just as good to increase to my 457. So 457 is also pre-tax. So that would do the same thing from a tax standpoint for as far as tax deductions. So the answer to that one's yes. Some people only have 457s in certain employers. So that would work for that. Stuart, you want to take some of these others?
Yeah, so I think we're getting some questions, specifically around Roth versus traditional, and that's really a common thing because obviously a lot more plans are adding Roth functionality now. And I would kind of piggyback on what Chris mentioned earlier. There's not exactly a cookie cutter solution for everybody in terms of when to save Roth versus when to save traditional. I think generally speaking, as an advisor, especially being younger myself, there's a significant benefit if you're a younger employee and you're maybe in a lower tax bracket earlier in your career to paying some of those taxes now today, even though you're not getting that tax break, to allow that money to compound and grow completely tax-free in a Roth account for your retirement. That's a general rule of thumb. And then I know, Brian, you mentioned it. Sometimes we have folks that are maybe further along on that journey to retirement and they're saving in the Roth, and it doesn't make any sense to be doing that when you look at their retirement income planning. So there's kind of two sides of the coin. Everyone's situation is a little bit different. I don't know, Chris, is that something that you see with a lot of clients and kind of consult on, is where to save in this scenario?
Yeah, I mean, I think I agree with a lot of your analysis. Of course, everybody's view on whether or not to do the Roth versus the traditional is going to differentiate a little bit because everybody's got a little bit of a different opinion. But essentially, what the opinion focuses on, the question you have to ask yourself is, what are my tax rates now versus my tax rates in the future? And if you think your tax rates are going to be higher in the future, or if you think that for some reason the government is going to make a push to increase taxes, well, then obviously it's a bigger benefit to get that tax free later on. So you would pick the Roth. If you think that your taxable income is going to suddenly drop when you get older, which for some people it does because they make less money, then it might make sense to do the tax deferred route and go that way. One thing I would also add is, I definitely, for younger people, I would say the Roth is an extremely powerful tool because of the effect of compounding. I don't know what formula NFP kind of uses to project things out, but in the back of my mind, I kind of figure if you invest in a well-known stock and you've got about 20 or 30 years to just sit there on it, you probably figure you might double your money, every 8 years? So if you've got 30 years to work with and you've got that money in there, your money is going to double potentially up to 4 times. If you're in a Roth, all that money is tax-free when you take it out. So it's extremely powerful for the people that have time to wait. The other thing I would kind of point out on the Roth front is, some people might not know this. I don't think I've seen the question yet, but if you are in an employer plan, there is no income limit for those Roth contributions. So if you're a highly compensated employee that makes $300,000, that income limit does not apply if you're in the employer plan. It only applies if you're doing the outside plan. So that's something that some people might not already know or realize.
Yeah,
I saw. No, sorry, Scott. Or were you gonna say something?
No, I wanted to wrap up. Go for it.
Yeah, I saw, just looking through the question, I saw another good one. How to lessen my tax payment. My husband and I earn $200,000. And then the next question was, is rental income considered ordinary income or capital gains? So I might kind of lump these together. So I get a lot of questions from folks. Brian, my spouse and I, we're maxing out our 401k contributions. We're already doing that. What else can we do? And that's where we kind of get into things like tax efficient investing and brokerage accounts. One of the things I see a lot is people are going and they're just buying like Vanguard funds, or even worse, actively traded mutual funds. And those things kick off a lot of dividends and cap gains that you don't want. You can't control it as well as you can in certain ETFs, certainly not through certain stocks, and you can't do tax harvesting with mutual funds. So tax efficient investing is very important. When I get a lot of clients, I ask them for the 1099 from their taxable accounts, because I want to see what those brokerage accounts are kicking off. And a lot of times we can move those things around and do more tax efficient investing to minimize the tax burden. And then what you also see a lot of people doing now is rental real estate and or some type of a side business. Because again, and remember what I said before, the tax code system, who God only knows how many pages it is now, like 10,000 pages, but it's really designed to reinvest in the economy. So by reinvesting in a business, there's tax benefits to doing that. By investing in real estate where people are going to benefit from using it, there's tax benefits. So when you have rental income, 99%, Chris can double check me, but it's ordinary income tax. But after you take in depreciation of your property, you take in all the maintenance costs, any like HOA, like all the costs that are going in. Let's say my costs are 30 grand for the rental, and my income are 30 grand, my income was 30 grand, passive income, I net zero taxes because I'm reinvesting into in essence, a business. So those are two things we see a lot of clients putting their time and money into once they've done some kind of the freebies, which is your 401k deductions and some of those things.
Yeah, I think that's a good segue. I mean, a lot of people are looking to obviously minimize their tax liability. And a question I get sometimes is, how do you filing status? How important is it? Is married filing jointly going to be better than, filing separately? And when does it make sense to really change those? I mean, Chris, maybe you can weigh in here.
Yep, I can. If you don't mind, I'm sitting here looking at questions myself, and there's two that I just think would be maybe beneficial.
Yeah, tie it in.
Yep. Well, they're kind of one-off questions, but there's one that's going to affect a lot of people. Somebody asked about the child tax credit and all the payments that they got, and whether or not how that's going to impact their taxes this year. It is new this year, and a lot of people are going to have it. So one thing is that it looks like they are issuing, the IRS is issuing 1099s to show what you received this year. So what will happen is everybody is eligible for a maximum amount based on how old their children are. And I think it goes to, might be $3,500 a year. But essentially, if you didn't get all the payments up front, you will get them as a refund on your tax return this year. If you got the payments up front, then you're not going to be penalized. It's not income. You're just not going to receive that as an offset against your tax liability. So that's how that works. And then you asked about filing status. Yeah, so filing status, typically with filing status, if you're married, filing joint is always, or not always, sorry, is almost always going to be the most beneficial status. It typically is just because the rates are much broader, the income requirements are higher for each different tax bracket. However, there are some cases in where it does depend. Usually we see where it might make a difference, or it might be more beneficial to break up the returns. If two spouses are earning very similar amounts, sometimes we'll see that. The other one we'll see is if you've got a wide variance in income and maybe somebody's got some really high expenses. And the one that comes to mind that you can sometimes deduct is medical. If you've got a spouse that has, for instance, a really low income, but they've got really high medical expenses, the chances are that they might be able to deduct a lot of those medical expenses themselves. Whereas if you were to combine the two incomes, both incomes would put them over the 7.5%, because you can't deduct medical expenses at all unless they exceed 7.5% of your income. So that could be a case where it makes more sense to break them out. And I would say for anybody that is seeing a CPA, your CPA should, or whoever is helping you file, we have a feature in our software that does allow us to actually hit a button. It'll break apart your return and show us the difference in the tax bill if we were to, do it filing separately. And obviously we'll do whichever one is most beneficial.
Got it. So you're kind of stress testing, it sounds like, a lot of your different returns for clients to kind of optimize their tax situation and help with the refund, right?
Absolutely, yeah, because every client is different, every situation is different. And so we really have to look at them on an individual basis.
Yeah, no, that makes sense. I want to launch another poll question here. This is kind of segueing nicely into, what people are doing. I'm just really curious to see, what your typical method is of preparing your taxes. So a lot of people, I think, are using like the TurboTax, the Tax Slayer. I think is maybe as these poll questions and answers come in, a lot of people, as they get more complicated, maybe get rental properties and a side hustle involved, if you want to call it, maybe they are hiring a personal CPA. Looks like, a lot of people are using TurboTax. Wow.
Good amount of CPA people though too, with personal CPAs. That's great.
Yeah. What are some of the pros and cons, Chris? I mean, to using kind of an online software. I mean, has that really caught up with, what you're using on your side? I mean, obviously there's a human element to it, which I think is so impactful. I mean, I know Brian and I could say that on the advisory side as well. It's so important to have somebody in your corner that you can call. And that's why a lot of clients like working with us. But I mean, where is the kind of the differentiator for you and your team?
The differentiator from where, there are some cases where an H&R Block or a TurboTax can definitely be the way to go. However, the biggest differentiator for us is anytime somebody probably has a business. even if it's a small business, because what inevitably happens, and we see this all the time, is anybody that runs a business is probably going to, especially if they're new, they'll have a question, or they'll do something wrong, or they'll need advice, or they'll get a notice from the IRS. The problem that I see with using an H&R Block in cases like that, many of those employees seem to be seasonal. They're not always there year round. If you have questions through the year, it might be tough to get somebody. Oftentimes, I've seen in many cases where they're not working with the same person every year. So it's very hard for them to know your history, to know the issues the clients had over the past, and it can kind of, create some inefficiencies there. Whenever I see somebody with a business or with payroll, I really see a lot of room for a CPA to add a lot of value, because the stakes are very high. If you mess up payroll, very large penalties. And there's just a lot of questions that come up where H&R and TurboTax just don't seem to be well equipped to handle those types of inquiries, 12 months year round. So that's where I see the biggest bang for your buck for having a CPA. And also, I think a lot of it goes with, we talked about filing status. Some of those things are very individual, personal questions where we break out returns to see which is more beneficial. I just see a lot of those, chain shops. They just seem to move. They're very equipped to move quickly through a very large number of very easy returns. But once you have a little bit of complexity or difficulty there, it's not soon after that it really helps to get a professional in there.
Okay, so I mean, what I'm hearing you say is if you were just a straight W-2 employee, maybe you and your spouse, probably not going to get a lot of additional value past the standard deductions. But the minute you get, rental property, passive income, maybe some of those outside accounts, it might be time to start looking at for a CPA.
Yes, and I would say rental is definitely another area in addition to business where we see a lot of questions because it is a passive activity. Losses aren't always allowed. Sometimes losses carry forward. We've had some, we see so many things. Sometimes, for example, if you just go in and out of an H&R Block, a lot of times you have losses that you can't take. Well, the year that you dispose of the property, usually you can take all your loss carry forwards. Somebody might have a couple $100,000 of losses that have saved up that can offset their income. And unfortunately, we see situations where that gets missed.
Wow.
That's just because, you get passed around with a different professional at an H&R Block or something, or just little things like that, where if you don't have a CPA or you have somebody that's just doing it as a part-time gig, maybe they're not as well versed.
Right. I mean, that segues into, is that a common mistake, or what's the most common mistake you see people make?
I wouldn't say that's necessarily a common mistake, but that's one of them. The other one that we see people make, just in general, one of the ones was talking about S corporations earlier, where people are having a corporation, they don't realize they need to take a salary, and not doing so is a big no-no, and it's a big red flag. That would be for somebody. We see those types of issues where somebody is doing like a TurboTax or really trying to do it themselves, and all of a sudden they miss that, or they don't realize that they've got to take that salary, and it just can really open up a can of worms, down the road if the IRS were to see it or find out or take issue with it.
No, that makes sense. Brian, I know you and I have talked kind of offline, and we dabble in the rental real estate kind of game, kind of the income side of it. I've gone back and forth with, forming an entity, is an LLC appropriate? Are your clients talking to you about things like that? And when do you bounce out to a CPA?
Well, I mean, a couple avenues to that. I mean, certainly the people's biggest concern right now, and certainly my own really, and for dealing with clients, is inflation. Like that inflation is a very big. If inflation is a monumental problem. With the way the government prints money, the way the Fed loads it to the banks, the way our market's down recently, bond funds are getting hit hard with rising rates. Obviously you got the Ukraine thing and COVID always looming these days. So where do I put my dollars to try to keep up with this 40-year high inflation? Most people point towards one of those areas being real estate, right? Because at the end of the day, like Facebook is a prime example of this, right? If you bought Facebook 2 years ago, you were very, very happy on your computer screen. And then last week, it got wiped down for basically a year and a half of losses in 2 days. and Facebook paid you nothing during that whole time. Facebook doesn't pay any dividends. So, it's always good to mix in things in your portfolio. Obviously, we all know real estate can go down. We all remember 2000, we all remember that happening. But to invest in something that's a hard asset that you can feel, that you can touch, that's paying you, that can also, by what you're putting in expenses, can wipe down your taxable income. Yeah, I'm seeing more and more clients do it. I'm also talking to clients about strategies where one spouse may not be working. So we get them full-time as a real estate professional by getting licensed and doing those kind of things. And then from there, not only can you take those real estate losses against the income, you can also take your real estate losses against the other income that you have in the household, not just offsetting what's called the passive income with the passive losses. So again, all this planning comes into play with a good CPA and a good planner, working on both your behalfs.
No, that makes sense.
I would piggyback off that, and the real estate professional, that's one that we do have a few clients that meet that category. And Brian is right about that, where you can, those rental real estate losses become ordinary income, or non-passive income. And there is a requirement for that. Usually half of your personal services for the year have to be devoted towards that activity, or you have to have 750 hours in that. But again, that's a great area where we can kind of look at that with you and see if you qualify for that to help lower your tax liability and really use some of those losses to offset ordinary income that's non-passive.
Interesting.
Like I had a prime example I can think of where a client had $40,000 in passive losses they hadn't been able to use because the rental wasn't just generating that much money, but the spouse wasn't working. So we ended up getting this spouse into being a real estate professional by the tax law, and they were able to write off almost basically off $40,000 on their taxes the next year. So it's things like that to look for, that obviously, like if you're doing rental real estate, like that's the value of a good CPA and a good planner, is because TurboTax isn't going to send you a note and know that, and be like, you got these backlogged losses. Here's what you need to do to minimize or to take those gains, or to minimize your losses in the future. So it's planning like that comes into play that can really help, because at the end of the day, a good planner, if I can minimize your tax liability, that just really helps me obviously get your wealth going in a much better direction, upwards.
Yeah, that makes sense. I mean, I know we got a ton of questions that have just kind of kept flowing in, which is awesome. And I want to get to more of them here. But one thing I did want to touch on that I think is really going to be relevant for everybody, we're getting a lot of questions on right now, is crypto and some of those alternative asset classes. So how is crypto being taxed? What should people be aware of? I know we've got people on the call that maybe are dabbling in this or considering dabbling in this. I mean, Chris, what's kind of the word on the street right now with this new cryptocurrency?
Well, there's definitely a crackdown from the IRS to kind of follow that and track it a little bit closely. You definitely know that when you see that there's an individual question on the tax returns about it. Did you trade cryptocurrency?
Yep, I noticed that this year.
Yeah, that's been there for, I think this is probably the third year. I'm seeing, I don't have many, but we do have clients that are in crypto. It's just, it would be, if there's any gain, it would be a capital gain. Many of the brokers of those currencies, and I'm not well versed in, I don't have any crypto, but I'm seeing them definitely issue 1099s for those now. So you should definitely be, if you invest in crypto for somebody, if you do not get a 1099 for anything that you sold, you definitely want to follow up and inquire about that. It's just the same as a stock. Once you sell it, if there's a gain, it's a capital gain, and there should be 1099s. And fortunately, I'm seeing a lot of those being produced now, whereas maybe they weren't a couple of years ago. So it's not free money. Just so everybody knows.
It's becoming more regulated. It's interesting how some things become the wild, wild west, and then the IRS gets involved, and there's kind of an evolution to that, and eventually it is more regulated. So I want to get to some of these questions here. A couple of them came in regarding college and funding for those. I don't know if you noticed those, Christopher, but there's a couple specifically. I think a good one is, what's the best way to pay for college? Whether it's a 529 plan, is it any TAP or Pell Grants? Kind of what do you typically see there from a tax side?
Yeah, I mean, I'm glad you brought up the 529 plans. That's a great way to save for college, because for those people that don't know, Unfortunately, if you're looking to save tax dollars this year, probably not going to get any or very little benefit from a 529 plan. But the big bang for the buck there is you can put up to $15,000 in there, which is the same as the gift tax limit. And the money would essentially grow tax-free. So essentially it takes on the same characteristics as a Roth IRA, except for the limit's much higher at $15,000. There are some states that do allow a small deduction if you invest in the state funded or the state backed 529 plan. I believe Maryland offers a $2,500 deduction per donor per beneficiary. So you get a little bit of a deduction there, but not much. The big bang is that the money grows. And then I did see somebody asked about, what can they do if they have a child that's currently in college? Well, there's a couple different programs. There's 2 credits. There's a lifetime learning credit and an American Opportunity credit. And typically they do have phase out incomes. I think for married filing joint, I've got it in front of me here. It's $160,000 to $180,000. So once you start to get over that $180,000 mark, you might lose that. But I believe you can get up to a $2,500 credit for 2021 for those expenses that you have for college education. And for the ones that have student loan interest, if your income is again below certain thresholds, you do get up to $2,500 as a deduction for student loan interest. So that's another one to think about if you're already done college, but now you're worried about trying to, figure out how to pay it off.
No, that makes sense. What about, we had a question coming about the child care tax credit. One of our attendees, it looks like the question said they opted out of it last year and then they're claiming it this year, but it's showing as a negative credit. You'd probably be able to interpret that a little better than I would, but I mean, is any thoughts on that, or does that question make sense?
I'd have to probably look just to get a little bit better idea of what they mean specifically by negative credit. But the way it should work is if your max credit for the year, I think the max might have been up to $3,500. If that's the max and you received it this year, what will happen is you'll take what you received, say somebody got $2,000 in advance credit payments. At year end, they will get a $1,500 credit against their tax on their bill. So if you simply take the $3,500 less what they received. There should be a 1099 that shows how much they received. If they did not receive any payments, then there probably won't be a 1099, or I would imagine it would show 0 and they would get the full $3,500 credit on their tax return.
Okay, got it.
I'll jump in on a couple of these, Stuart. I saw one ask, can I open up a Roth for a child instead of a 529? What if the child doesn't go to college? So to open up a Roth IRA, you have to have earned income. So I've literally seen it where, someone owns a business and they put their child on the brochure of the business and they pay him X as like a baby model. Like I've seen all these crazy kind of planning things to do it, but the child has to have earned income to give to a Roth account for them. The 529 is technically owned by the parent for the benefit of the child. So that can be opened up at any time. And honestly, that can be opened up before they even have the child. And I can tell you, like my wife and I don't have kids. I opened up 529s for the plans on having them 7 years ago, just to take advantage of compound interest. And then you can just change the beneficiary. So to the point of, if your child doesn't go to college, you can do a couple things. One, if you end up taking the money out of the 529 for non-college account or non-educational expenses, then you're going to pay taxes plus a 10% penalty. Or you just keep it for some type of educational expense for grandkids or another child, and you can change the beneficiary from X child to another one. And the IRS is very lenient. Like you can buy home computers and different things. You're not going to get audited on that kind of stuff. The other things I see a lot of clients doing, it's a good segue for this, is buying I-bonds. So I-bonds are inflation protected bonds that are issued by the US Treasury. And they just got the highest increase because the government changes their rate semi-annually. They're paying 7.12% risk-free. You can only buy $10,000 per person per social security number, but you could buy them for your kids. And if they end up using those for college, then the gains you get on that interest are tax-free. So basically every client I have that has more than $10,000 in the bank they don't need for at least a year, they're buying their I bonds. You have to hold them at least 1 year. You dump them before 5, you lose 3 months, the last 3 months of interest, not a big deal. But in an interest rate environment where people are looking for something better than 0.25% from the banks, you see a lot of people picking up those I bonds, especially for their kids in a plan for college versus putting them in a 529 that's bouncing all over the place in mutual funds.
So is it safe to say, I mean, that's something you'd probably utilize more if a student's a little bit closer to college age, right? Where you don't want to open up a 529 and dump it in there and risk volatility right before they're maybe going to need to be starting those distributions. I know you love those I bonds, like we've talked about it before, and they're not usually relevant. I feel like, for years with interest rates being so low and inflation being relatively normal, and now suddenly I bonds are really the way to go.
Yeah, I mean, again, obviously it's a conservative risk-free asset, right? So it's basically almost like a bank account. I mean, it's basically paying over what a 10-year CD is paying right now to lock up your money in a 10-year CD. So again, most people are trying to pick these up. You can also get another 5,000. If you typically get a refund on your tax returns, you can file a 8888 form with your taxes this year to get up to $5,000. If you have anything up to 5,000, let's say you get a $7,000 refund in your taxes, you can get up to 5,000 more on your tax return. So I'm seeing more and more people do it because, again, the biggest concern people have is inflation, and with the stock market down and bond funds getting eaten up with rising interest rates, but yet rates aren't rising enough to where individual bonds are paying much more than 2-3%. I mean, they're really a freebie that a lot of people are gravitating and grabbing onto to try to keep up with the cost of food and gas and all these other things that are skyrocketing in front of us.
I saw a question on here, if it's okay if I can answer it.
Yeah, let's get to more of these.
And I can't remember the exact question, but I'll just touch on the topic because it's a broad topic. Somebody talked about contributing to a health savings account, which I think is, I would just be mad at myself if I didn't discuss that as a tax saving mechanism, because it really probably is the single best tax deal that there is right now. The thing with HSAs, for people that don't know, if you have a high deductible plan and it does qualify, you can contribute up to $3,650 as an individual and $7,000 as a family for 2021. The thing that is great about the HSA, there's a couple things that I would point out. With retirement, you get out of state and federal tax. With the HSA, if you do it through payroll, not only do you get out of state and federal tax, you also get out of Social Security and Medicare tax, which is an additional 7.65% in tax. The other thing about the health savings account is that it continues to grow, and it actually converts into an IRA at the age of 65. So once you hit 65, you can actually take out the money out of the health savings account, and there is no longer a penalty for not using it for medical expenses. I know somebody that's put about $250,000 in their HSA account over the years, and now she can essentially take that money out and buy a new house with it, and there's no penalty for doing that. So you really you're getting out of federal, state, and Social Security and Medicare, and there's nothing else out there that enables you to do that. And also, once you hit 55 on that, you get $1,000 catch-up. So if a couple opens 2 separate HSA accounts and they're over 55, that's $9,000 they can put away. No state, no federal, and no Social Security or Medicare tax.
Yeah, that's pretty amazing. I think we call it in our industry, we call it like triple tax free, because it really is like you're putting that money in, and if you're not touching it, you're getting complete tax-free savings, and you avoid the Social Security side as well when it converts over. I mean, one thing I've tried to do personally, and just I've advised some of my clients to do it, is, if we all have those small reoccurring medical expenses, those checkups and things like that. I mean, I use an HSA personally. I try to just pay my copays out of pocket rather than even dipping into the HSA, because my mindset is, hey, the longer I can keep this money growing, it's compounding, and it's ultimately going to grow quicker for me for a bigger expense down the road as I, try to get it moving in the right direction. I mean, does that make sense? Like, is that something people should be thinking about if they can afford to do it, of course?
Absolutely. I think it's a great way to save, especially the other thing, I want to talk about inflation. Inflation of 7.5% is nothing compared to what we've seen in the medical and insurance industry over the last probably couple decades now. So if you're really trying to look for an area to save for and tackle, for me, it would be self-preservation. So I would definitely put some of those dollars away for health expenses.
Yeah, no, that makes sense. Well, I think we're kind of wrapping up here. We're getting a few more questions. I want to encourage everybody to reach out. I mean, obviously, there's a ton that we're covering, and a lot of your questions are very specific. We want to get you the best attention to those questions. So after the kind of the podcast today, there's going to be a link going out with a recording for the session. We're also going to include in that link Chris's contact information if you'd like to get in touch with him and maybe talk a little bit about your tax situation. We'll also include the link for Brian and myself to get in touch with us if you're maybe looking for an advisor, you just want to run some ideas by us and kind of interface with us more closely. That email address is planning@mywellsense.com. So that's a new email that we've set up that you'll have an opportunity to reach out to us there as well. I mean, Brian, any final thoughts as we start to wrap this up here?
Yeah, well, I said a couple of things that came through since you guys were talking. So an FSA and HSA, the flex spending account versus the health savings account, the FSA is use it or lose it. So they're both pre-tax, but the HSA carries over. So if you don't use typically any clients that have FSAs through employer, they don't have HSAs. Obviously, we tell them to go to like Walmart or something, or Walgreens by the end of the year and just stock up on vitamins or whatever it is to use that. But so that stuff doesn't roll. The HSA continues to roll and build on itself, which is, again, the HSA is better than 401ks. It's better than Roths just because it's triple tax free. It's pre-tax in and tax free out on the back. So, no, look, I mean, honestly, they're phenomenal questions all the way through here. He said, Stuart kind of gave you our contact info. We're happy to be a resource. Again, we'll continue to do these throughout the year. We thought this was obviously a great planning segment given it's tax time and to get, one of our valued colleagues like Chris on here to talk about all these various tax things. But no, phenomenal questions. Like I said, feel free to email us. We'll kind of look at your stuff individually. The other thing just to mention, and we didn't talk too much on it, is just for any of those people that are on the call that are business owners and or they have spouses that are business owners, so much you can do there as far as making sure you're writing off all the expenses of the business, solo 401ks, SEP IRAs, all these things that we can do to maximize retirement and, limit the tax liability. We're doing a lot of that business planning stuff that can really help mitigate the taxes.
No, awesome. Chris, any final words, any thoughts, last pearls of wisdom you want to share as people go into tax planning season here?
Yeah, I kind of wish everybody the best of luck. And I mean, definitely if you're somebody that has a wage, I mean, retirement and health savings accounts are probably your way to go. For those people that are more complex and have businesses, we can probably get creative and think of a lot of ways to help you out. We would definitely love to hear from you. I think they said they've given my contact information, but the name of the firm is Tyler and Company LLC. We're in Ocean City, Maryland. If you Google us online, we'll come right up, and somebody would be glad to get in touch with you and help you out the best that they can.
Thanks, Chris. I mean, as we say, there's two things you can be sure of: death and taxes, right? So it's
absolutely.
we try to pay our fair share, but also minimize the liability as much as possible.
I don't think it's changing.
Nothing wrong with that. So I want to thank everybody again for coming on. Our commitment is obviously to keep these fresh, to keep these engaging. We love the interaction that we're seeing from everybody today. I wish we could get to more of your questions, but again, don't hesitate to reach out to us, and we'll definitely interface with you and make sure we get some more of those questions answered. And we'll continue to bring you some of these podcast style webinars that are going to be relevant, to different times of the year and what we're all going through. So thanks everybody for your time, and we look forward to seeing you again next quarter.
Yeah. Thank you, everybody. Really appreciate your time. Stay safe.